Hello everyone, welcome to Chapter 15 and Accounting for Leases. To start, let's talk about some terminology. First of all, a lease is an agreement in which the lessor, the lessor is the person who owns the property, conveys the right to use the property, plant, and equipment, usually for a stated period of time, to the lessee, who is the renter. I don't know if this will help you, but I always think to myself, the lessee is like me. Since I don't have any property myself to lease to people, I would be like the lessee. The person who is leasing the property from the lessor. Unfortunately, I don't have any rental properties or income producing properties or anything to rent out, so the lessor wouldn't fit for me. However it works for you to remember it, just remember throughout this chapter that the lessor is the owner, the lessee is the renter or the borrower of the property. Okay, so there are two different ways a lessee can record a lease. The first is as an operating lease, and the second is as a capital lease. The lessor can record the lease as an operating lease also. So if the lessee records as an operating lease, the lessor should be recording as an operating lease likely as well. Or if a capital lease for the lessor, they have the option of recording it as either a direct financing lease or a sales type lease. And we're going to go through all of these. So every type of lease and how they get recorded as we go throughout this chapter. The primary difference between an operating lease and a capital lease is a capital lease is treated more like a sale, with the ownership of the property being leased being somewhat transferred to the lessee. Whereas an operating lease, the lease is purely for borrowing, if you will. So the way I kind of think of an operating lease is if, let's say, you had a store that you wanted to open up in the mall, and you engage in a lease with the owner of the mall to rent a space. And when that lease is done, the lessee would leave, or continue. If the lessee didn't re-up, the lessee would leave, and the lessor would have their property back. Okay, so that's like an operating lease. And the journal entries for operating lease are the ones you've been dealing with pretty much since financial accounting, which is simply a lessee would pay, and they would have a debit to rent expense, a credit to cash, and a lessor would have a debit to cash and a credit to rent revenue. Okay, there's no transfer of ownership. The lease property goes back to the lessor at the end of it, and that's a simple operating lease. A capital lease, as I said, is designed really to almost transfer the ownership of the property. And there are a couple rules that we're going to go through to show how when you classify something as a capital lease. All right, so here's the classification criteria. You can capitalize as a capital lease if you meet one of these four criteria. And we're going to go through each one of these. Sorry, my dogs are noisy. All right. The first option is if ownership transfers to the lessee at the end of the lease term. All right. If that's the case, then it's a capital lease because really it is a transfer of ownership of the property. The second one is a bargain purchase option exists, and we're going to talk about each one of these in turn. The third one is the non-cancelable lease term is equal to 75% or more of the expected economic life of the asset. So, I don't want to get into too much description because we are going to talk about each of these. And the fourth one is the present value of the minimum lease payments is 90% or more of the fair value of the asset. Now, all that has to happen is the capital lease must meet one of these criteria. It doesn't have to meet all four, just one. And if it does, you can record it as a capital lease, or the lessee can record it as a capital lease. The lessor actually has two additional requirements, which we're going to get to in a few minutes. First, I'm going to spend a little bit more time talking about each one of these. Well, the first one of these is self-explanatory. Ownership transfers to the lessee. They're basically buying the item that they're renting, all right, but that they're engaged in a lease for, all right, because the ownership transfers. They're buying it. It's simply a matter of almost like a loan that they're borrowing. All right, I'll give you an example. My husband used to have an automotive repair shop for a number of years, and he needed new lifts in the repair shop. Well, he entered into a lease agreement with the company that sells automotive lifts. So what happened is, clearly they're not taking all the automotive lifts back out of the shop once the lease is over, but it was like a loan. It was called a lease, but it was basically a loan. He paid the company over a period of time, and at the end of time, the ownership of the automotive lifts transferred to him. So it's almost like a loan situation. All right, the second one, a bargain purchase option. So with a bargain purchase option, the lessee has the option of buying the asset at the end of the lease for less than the fair market value, and usually significantly less. So maybe maybe at the end of the lease, the item that you're leasing is worth $5,000, but you have the option of buying it for $500. That's a bargain purchase option. Okay, so it's a bargain price. We're not talking like $1 or $2 difference here between the fair market value and the bargain purchase option. It's usually a significant discount because really it's almost like a sale as well. The third one, and we're going to do the math on these, the third and the fourth one in a few slides, but the non-cancelable lease terms equal to 75% or more of the expected economic life of the asset. So let's say this asset is supposed to last for 10 years, all right? If you're leasing the property for only 5 years, then you don't meet this requirement because 75% of 10 years would be 7.5 years. All right, but if the lease term is for 8 years, then you have used this thing for the most of its expected economic life, and it is considered to be, you've used up all the usefulness, if you will, of it. So it is considered then to be a capital lease because it's like a transfer of the property. And the fourth one, the present value of the minimum lease payments is 90% or more of the fair value of the asset. So for all intents and purposes, if you as the lessee have basically paid for this asset, you've paid 90% or more of the fair value of it. If that's the case, you've spent almost all the money for what it was worth, and it's going to be considered basically a transfer of property. It will be treated as an operating lease. And as I said, I will show you numbers on that. Okay. This slide just gives you a little bit more information on a bargain purchase option. The one thing I wanted to note in here is that if you're starting the lease, the inception of the lease, the beginning of it, is actually during the last 25% of the asset's economic life, then we don't use this criteria. So basically, let's say you're buying a truck or something, you're leasing a truck, and the truck is going to be good for 10 years, but you are entering into this lease in year 8. Well, that's past the last, the first 75% of the lease's life, of the truck's life. So you're entering into it in the last 25% of the time it's expected to be useful. So in that case, you can't use the bargain purchase option as one of the criteria for whether or not it is a capital lease. For the lessee standpoint, and I'm going to switch over, I actually have an older set of slides that gives better examples for numbers than these slides do, since these slides don't give any numbers at all, really. So what I'm going to show you is I'm going to show you the, sorry about that, got interrupted by dogs, phone calls, etc. So where I left off, I believe, was talking about this part, right? We finished talking about this. Just a note, for the lessee, a capital lease is recorded at the purchase of an asset. The lessee records both an asset and liability at the inception of the lease. So let me show you what that looks like from a different set of slides here. As I said, or I started to say, I'm switching between an old set of slides and a new set of slides. So this old set of slides gives you numbers, the new set of slides gives you no numbers. I don't know why, but if you were to look at what the publisher is giving you now, they wouldn't have any numbers, so you wouldn't find this example anywhere except in the screencast. And an older edition of the book, of course. All right, so here's what we're doing is we're comparing capital leases to installment notes. And I want you to realize that the journal entries for the installment notes and capital leases are virtually identical with very slight wording changes. And the calculations are the same. All right, so Matrix Inc. requires equipment from Apex by paying $193,878 every 6 months for the next 3 years. The interest rate associated with the agreement is 9%. So this amortization table would be the same amortization table whether you're dealing with an installment note or a lease, or a capital lease rather. So here's your outstanding balance of $1 million. You're paying every 6 months. So this first effective interest rate is calculated at $1 million times 9%, which is stated here, times 6/12 because it's half a year. And then it will get you your $45,000. The payment's $193,878, so the difference between the two would be a decrease in balance of $148,878. So you would take the outstanding balance of $1 million minus the $148,878 would give you the $851. Now when you calculate the second interest, it's $851,122 times 9% times 6/12, or half a year. And you would come up with effective interest of $38,300. The trick is that you're always multiplying, you're coming up with the effective interest rate by multiplying with the current outstanding balances times the 9%, the effective interest. All right, and you're always reducing the principal by the amount of principal payment made each payment. So here's you're dealing with the 6 months. This is the amortization table. Let's look at the journal entries. Since we just completed the installment note chapter, many of these should be familiar to you, and you realize that it's pretty much the same journal entries. So if it was an installment note, your journal entry would be a debit to equipment for $1 million, credit to notes payable, January 1st. If it's capital lease, debit to equipment, credit to lease payable. All right, that's really your only difference. The first semi-annual payment, 6 months later, June 30th, you'd have from the table, the numbers, I'm pulling the numbers from the table, a debit to interest expense for the interest piece, credit to cash for the cash payment, and the difference between the two is the debit to notes payable, reducing your liability. Well, a capital lease, the only difference here is the fact that you're dealing with a lease payable instead of a note payable. All right, so I mentioned before that if you are the lessor, you have 2 additional considerations. You must meet one of the first considerations, but you also must meet 2 of these as well for the lessor to be recording it as either a direct financing or sales type lease. So, and we'll talk about the differentiation between those in a few more slides. The lessor also has to be convinced that they will collect the lease payments and that they're reasonably predictable, right? It's not really a sale or a capital lease if you're not sure you're going to get paid for the lease. All right, you don't want to be recording revenue that you haven't actually earned. And the other piece is if any costs the lessor have yet to be incurred, they are reasonably predictable. All right, performance by the lessor is substantially complete. So the lessor has done pretty much the majority of what it needs to do to ensure that this lease is good to go. Okay. All right. Here's a slide that shows the difference between the GAAP and IFRS on leases, and actually you guys have a required forum posting that is the difference between IFRS and GAAP, and I wanted you to choose an item so somebody could choose leases if they wanted to explore this a little further. Okay. Just to note, as I said earlier, if you have a lease and none of the criteria are met, you're going to be recording it as an operating lease. That's pretty much your default. All right, and I talked about before what your journal entries would be. It would just be, like I said, a debit for rent expense, credit to cash. If you are the lessee, and if you're the lessor, it would be a debit to cash, credit to rent revenue. So similar to the journal entries you've pretty much been seeing all through financial accounting.